It is a great pleasure to welcome you all in Sintra, and this is the 13th forum in Sintra. Over the last 13 years, Europe has faced an environment of extraordinary pressure that called for unconventional responses. The sovereign debt crisis brought us towards the effective lower bound. We were not the only one. The pandemic collapsed demand further. We responded with asset purchases and refinancing operations to support the economy and new instruments to address fragmentation. Our toolbox expanded in other ways too. Forward guidance with lift-off criteria, forward guidance sequencing commitments, forward guidance links between different policy instruments. When the environment reversed and Russia cut off our access to natural gas, we responded with a conventional instrument used in unconventional ways. The fastest tightening cycle in our history, raising rates in increments we had never used before, 75 basis points at a time. But in today's environment, monetary policy now finds itself in a different position. We no longer need to reach for unconventional instruments. While we have them at hand, we can now focus on stabilizing inflation with policy rates as our primary tool. We no longer need to act with the same force. We can make measured adjustments to rates, calibrated to the shocks we face, and we no longer need complex forms of forward guidance. Our decisions are data-dependent and taken meeting by meeting. So monetary policy has gone back to basics. Has it? A return to basics does not mean a return to the same idealized past, if there was such a thing in monetary policy ever. As Edmund Burke once wrote, a state without the means of some change is without the means of its conservation. The same holds for monetary policy. Today's world poses challenges that require us to apply those basics in new ways and to innovate where our existing frameworks fall short. And that's what I want to discuss with you tonight. So back to basics. Several factors have made the return to basics possible. The first is how the world has changed. Interest rates have moved away from the effective lower bound, driven in part by structural pressures that includes, in particular in this part of the world, rising defense spending. And the shocks of this era are more likely to fall on the supply side than on the demand side. Because these negative supply shocks have tended to push prices upwards, interest rates have moved away from the effective lower bound. But the shift also reflects, perhaps more fundamentally, the policy framework Europe has built in response to these crises. By making the economy more resilient to shocks, this framework has reduced the need for unconventional or forceful policy responses. Those of you veterans of the great financial crisis and the sovereign debt crisis will remember monetary policy is the only game in town. I don't think we've heard that so often recently, and I hope we don't. The ECB's own instruments have reduced fragmentation risks, including the Transmission Protection Instrument, often referred to as TPI. These tools make it less likely that we observe unwarranted movement in sovereign spread. They also mean that we can raise rates to address inflation without the concern that tightening itself becomes a source of financial stress. In addition, the strengthening of the European institutional architecture has weakened fragmentation by tackling, not to perfection, but by tackling the bank-sovereign nexus from both sides. European banking supervision, and I salute the supervisors in this room, and the European resolution framework have made the banking sector more resilient in Europe, so that shocks are less easily amplified by the banking system. Though we need to remain mindful that financial stability challenges may be building in non-bank financial intermediation, where oversight has not kept pace, as was discussed a couple of days ago in Basel. European fiscal frameworks have also developed considerably from the ESM, the European Stability Mechanism, to Next Generation EU and other common borrowing instruments, weakening the nexus between the sovereign side and the banks. At the same time, there are reasons to believe that European policy responses are also reducing how far shocks pass through to the real economy. Our strategy assessment found that the anchoring of inflation expectations has moved closer to 2%, reflecting the ECB's clear, symmetric target and its track record in fighting both too low and too high inflation. And that is critical for insulating the economy from undue second-round effects of imported energy shocks. The clean energy transition is also beginning to alter how those shocks are transmitted to the broader economy. In countries with higher share of low-carbon emissions, electricity in particular, like Portugal, Alvaro, thank you for having us, and Spain. Where are you? Thank you for that. You're setting standards. And France, with nuclear power. Wholesale electricity prices have increasingly decoupled from gas prices. And this resilience has been clearly visible in recent years. The failure of Silicon Valley Bank did not destabilize euro area banks. The euro area has also weathered the largest US tariff increase in almost a century, as well as what the International Energy Agency has called the largest oil supply disruption in history. That didn't go without a significant cost. It has been substantial, but the economy has not been derailed. Cyclical fluctuations have remained contained, even if some of these shocks do pose challenges for Europe's long-term growth outlook. That resilience has allowed monetary policy to focus more squarely on its core job, stabilizing prices through interest rates without being constrained by fragmentation risks, banking sector vulnerability, or the lower bound. But if we're back to basics, we're not back to the past. Because the world in which we apply these basics has fundamentally changed and is different from what came before. We face a charged geopolitical environment in which the frequency of major shocks looks to be rising, and these shocks are also taking on new forms. Market access, energy supplies, critical minerals are increasingly being weaponized, and there is more than that. Shocks of this kind have two features that challenge our standard analytical framework. Let me take them in turn. First, the economic effects of those shocks depend on strategic reactions that may not follow historical regularities, to say the least. Last year's imposition of higher US tariffs provide a vivid illustration of that. Most economic models that were produced by your teams and mine predicted that the euro would depreciate against the US dollar, driven by expectations of higher US rates and a smaller US trade deficit, and that uncertainty would weigh heavily on investment. Many observers expected the EU to retaliate, raising import costs. But the reality was different, and in practice, the euro appreciated sharply against the dollar as investors re-evaluated America's position in the global financial system, at least for a while. The EU did not retaliate, to the regret of some, but it did not, prioritizing its strategic relationship with the United States over its own commercial interests. And European governments responded to the broader geopolitical shift with the largest increase in defense spending in decades an endogenous response that partly offset the drag from trade. That's the first feature. The second feature of these shocks is their capacity to escalate sharply, but also to swiftly unwind. And the war in the Middle East is a case in point. The conflict has generated significant inflationary pressures, but at every stage, judgments about its length, its depth, and implications for the outlook have shifted. Cycles of escalation, negotiation, denegotiation, renegotiations, announced agreements, and reversals of such agreements have moved oil markets rapidly, sometimes in a matter of days. Remember, in March, oil prices surged to nearly $120 per barrel, and worst-case projections were far higher. Following last week, interim peace agreement, let's hope, prices have fallen back to around $72 per barrel. Though the durability, sustainability of this agreement is far from assured. So taken together, the picture I have described pushes monetary policy into new terrain. While we're more likely to face shocks that push inflation away from target, the resilience Europe has built means the effects on our economy are more contained. As a result, we may more often find ourselves in an intermediate zone between shocks we can look through and those we must react to forcefully. At the same time, they're harder to read and more likely to change course quickly. So a proper calibration of our policy response is essential. And forward guidance is not in the cards, nor is certainty for that matter. So how are we meeting this challenge? Through innovation in two areas. And it's pretty fitting that innovation is one of the key themes of the conference that we have in the next 2 days. First area of innovation is ensuring that we have indicators that are sufficiently concrete and responsive to support decision-making in this environment. One view holds that, given the feature of today's shocks, monetary policy should put a greater weight on inflation expectations. Since we cannot offset supply disruptions directly, we know that, our decisions should be calibrated on keeping expectations anchored. Inflation expectations are a key part of the data that we monitor, and will always remain so. Any signs of a de-anchoring in longer-term expectations will undoubtedly warrant a reaction. Faced with large and persistent shocks, it may also be appropriate to forcefully react before de-anchoring becomes visible, because by then it's too late. But when we find ourselves in this intermediate zone I have described, relying on expectations to calibrate policy also has its drawbacks. Stable longer-term expectations can potentially lead policymakers to delay responding to inflation that is already above target and being felt by households and firms, even when forecasts and incoming data would call for action. Conversely, if policymakers act to preempt a future de-anchoring, there is no reliable way to gauge how far rates need to be raised, or to know after the fact whether a preemptive response was actually necessary or excessive. But advances in the data we use and in how we use them now gives us a sharper and more timely picture of what is happening in the economy and a firmer basis on which to calibrate our decision in the present environment. First, tribute to our staff and their leaders. We have done considerable work at the ECB since 2022 to understand how concrete, real-time data map into medium-term inflation, particularly through developing our battery of underlying inflation indicators. Really important, and we have a whole variety of them. Tools such as the persistent and common component of inflation have well-established leading indicator properties. Second, we have invested significantly in improving our projections. We had our projection errors, like so many others, particularly during the 22 inflation surge. And it resulted in a switch to more granular forecast. That's what we do now, for oil, for gas, for electricity, among other improvements. Projection errors since the outbreak of the war in the Middle East have been very small as compared with what we experienced after the war in Ukraine. These projections give us a more complete medium-term picture not only of the inflation outlook, but of how it will respond to policy changes. This helps to calibrate policy that is far better suited to the environment that I have described. And the two actually reinforce each other. We can continuously cross-check our forecasts against incoming data to verify whether they remain on track so that we do not end up relying on forecasts that are out of date. This framework was central to our most recent monetary policy decision. Some have characterized our rate increase earlier this month as an insurance hike. Oh, sorry to disappoint them. That is not an accurate description of our decision. I mean, all of you know that in this room. We faced an outlook of rising headline, rising core inflation, and a projection that saw inflation returning to 2% only in the last quarter of 2027, which was itself conditional on monetary policy adjusting. Our analysis showed that holding interest rates constant would have left inflation north of 2% in 27 and 28. This was a decision that was based on what we had, what we saw in front of us. And our ability to take it with confidence in an environment of considerable uncertainty is the product of years and years of investment in our data, our indicators, our projections, and our people. But in an environment where shocks can change direction so quickly, it would not be wise to anchor our decisions too firmly in any single indicator or projection. So the second innovation is in how we evaluate our decisions across different states of the world. Imagination is our limit. Since our strategy assessment last year, scenario analysis has become a core part of how we take decisions under heightened uncertainty. It allows us to test whether a policy decision holds across a range of plausible outcomes and to identify in advance the conditions under which we would need to change course. This was particularly useful at our most recent meeting. In addition to the adverse and severe scenarios that we had already prepared in March, we included a milder scenario in which energy prices turn out lower than currently envisaged. We added this scenario precisely to capture the possibility that geopolitical shocks can unwind faster than expected, as we have seen with the Strait of Hormuz, maybe. Our rate increase was justified under every scenario, the milder, the adverse, and the severe. It was by design a robust decision, and nothing we have observed since then has called this assessment into question. Energy futures prices remain within the range of the scenario that we have modeled. Now, publishing this scenario, which is also something that we debated, also, we believe, contributes to the robustness in another way. And that's an important point. It helps the public, particularly those really interested in those decisions, the analysts, those who observe carefully what we do. It helps them track when we may be moving from one scenario to another. But to anticipate how we will respond, this is not going to be enough. They also need to understand very well our reaction function. And here I would like to identify an important distinction that certainly I make between forward guidance which we have set aside given the uncertainty that we face, with framework guidance, which is something that we actually practice. Framework guidance as opposed to forward guidance. Our rate decisions are guided by 3 criteria: the inflation outlook, underlying inflation dynamics, and the strength of monetary policy transmission. Because this reaction function is now well understood by markets, markets do not wait for us to act. They adjust financial conditions in response to new data on their own. So monetary policy begins to take effect before we have made a decision. And that buys us time to assess how a shock is developing before we commit to a course of action, which is highly valuable in conditions of high uncertainty. And we've seen this play out over recent months. When the energy shock from the Middle East conflict began to feed through to the inflation outlook, market rates started tightening in March, well before our decision in June. That allowed us to gather more data, calibrate our response with greater confidence than if we had felt compelled to act immediately. The markets did the work for us. In this case, the data came in broadly as expected, and we raised interest rates. But we have also had situations where initial expectations were not validated. Remember the weeks after the US tariff announcement in April 2025? Markets priced in substantially lower rates, with a terminal rate as low as 1.5%. Our framework guidance gave us the space to wait and see how the shock played out, which was ultimately different from what most observers initially anticipated. The easing cycle ended at 2%. So we contend that in times of uncertainty, forward guidance loses its value, but framework guidance becomes far more valuable. When markets understand how we will respond across different states of the world, they can begin adjusting before we need to act, and that allows us to take more robust decisions. So, ever since we met here in Sintra, an environment of extraordinary pressure has demanded unconventional measures. Today, the environment for monetary policy has changed. Shocks fall more often on the supply side, and Europe has built considerable resilience in response to those difficult years. It's fashionable to bash Europe. It's fashionable to deny the need of supervision. I contend that those 2 elements have been material in order to help us stay on the stability track that we need to follow. It has created the space for monetary policy to go back to basics, stabilizing inflation with policy rates as our primary tool, acting in a measured way, and taking decisions meeting by meeting, not anticipating what we're going to do next time around. And yet, the world we face is no less demanding, and we will continue to change with it. The basics have not changed, but what it takes to apply them has changed, and we will all stay tuned. Thank you very much.